It's been a strong year. There's been people talking about if January and February, if the gains hold, that 38 out of 39 times that meant a really good return for the year. Did anything surprise you after the December 24th and December 26th action? Were you surprised by this rebound?
So I think I wasn't surprised by the rebound, and I think it's important to take the starting point into account. I mean, the re-rating that you saw in valuations really set us up for fairly attractive returns over the course of this year. And what's most interesting to me is if you look at what's driven the rebound since the beginning of the year, since Christmas Eve, wherever you kind of want to draw the line in the sand, it's really been all about multiple expansion. You've actually seen expected earnings growth begin to come down. And to me, that means that there's just a lot in the price. I mean, back in December, we were having conversations of mid to high single digit returns for this year. And now we're at mid to high single digit returns for this year. The question is what happens next? I think that the market is expecting the Fed to remain relatively dovish. I think the market's expecting growth to remain moderate. And I think that the market's expecting a deal on trade. And frankly, I'm just not sure that we're going to get all three.
Well, I think the multiple expansion you're referring to probably was a direct result of the shift in the Fed's.
Yes, 100%.
Which brings us to R.J. Gallo. Munis always make sense, I guess. They're probably now more than ever in certain SALT states, I guess, right, R.J.? I mean, the yields are so low. I hate to lock things up for a long time, but suddenly we went from 3 1/4 to 2.6 on the 10-year. So maybe, were you recommending munis last year?
Yeah, we were bullish on munis in 2018. The tax bill cut muni new issuance quite drastically, and we expected that would position munis for favorable relative performance last year, which occurred. Munis outperformed the ag by over 100 basis points. But it was a low return year. Rates backed up sharply until the reversal of the fourth quarter. I think the Fed's patience, pause, reassessment of the balance sheet, all those things underwrote the sharp bounce back in risk assets. And now we have an interesting dynamic. The risk asset bounce has occurred, as you guys just discussed. The question is what's next? And on rates, we're getting pretty neutral. You can come up with a scenario where the U.S. economy decelerates, but certainly doesn't go into recession. Inflation holds, maybe rises as the year goes on. Rates would rise a bit in that scenario. Maybe the Fed gets back in the game tightening. Conversely, you have many policy risks. China-U.S. trade is the biggest one. You also have the debt ceiling debacle could be repeated here in the United States. And you have slowing global growth. Those all could pull rates down. So you can see there's countervailing forces. So at the moment, we see some symmetry to the rates outlook, which is good for bond returns from an income and carry standpoint, good for munis, good for high yield, good for corporates and other assets that do better as the economy keeps expanding, but the Fed is sort of on pause.
We had Bullard on yesterday. It's actually trending on Twitter.
Really?
I don't know how. Because they're millennials, right? I mean, were they actually watching Bullard? So that was cool for that to happen. But he keeps making the point, RJ, that we have no idea what a normal interest rate is at this point, and it's no longer 4.5% to 5%. He thinks we're there now. So I would figure you would have to go to your investors and you'd have to tell me, like over and over again, that I can't look at the absolute level and think, why would I buy a 10-year bond for two? You have to recalibrate everything you've ever learned about buying long-term bonds, because if rates go down from here, it doesn't matter that you went out 10 years. You're going to make money, but it's hard to lock up your money in my mind for such a low yield for such a long time. I worry about principal risk, but we need to get beyond that.
It is a little hard to fathom, but I think for many people, certainly for me, many people on the show, people watching the show, much of our lives really, from the late 60s all the way up until the 90s, yields were sharply higher than they are today. But when you think about the context of the world, what was going on over that period of time, there was a big inflation mistake on the part of the Federal Reserve in the 70s. At the same time, we had inflationary problems all over the world. Since then, more independence in central banking, aging demographics throughout the developed world, slower rates of potential growth, and more inflation credibility. Inflation has not been the problem it was 20, 30 years ago.
Let me get one more.
So real rates matter a lot. And real rates around 1% aren't that shocking. They used to be 2 to 3.
David, if we get a deal when it comes to China, what does the market do? Does it go up, or is it all priced in? If we don't get, where's the risk?
So I think that there's a lot priced in. I saw an article actually on your website yesterday that a gentleman was saying that perhaps there's not, the trade deal hasn't been entirely priced in. My view is that the majority of what the market has done is based on two things, right? It's based on resolution of trade, and it's based on the Fed remaining relatively dovish. I think what's been most interesting is if you've watched volatility during this whole period, right, it's come right back down, and that Fed put feels like it's back in place. Now, the Fed has been adamant that the Fed put is not in place, but their actions and their words are signaling two slightly different things. So I think the key thing for investors to focus on this year is really policy, right? Trade policy on the one hand, Fed policy on the other. There's going to be a tug of war between those two because, again, if we get resolution on trade, I think the Fed's going to want to hike rates as long as the economy isn't slowing too quickly, which obviously, given some of the data we've gotten over the past couple of days, is a risk, but not one that we see playing out over the full 2019 year.